Okay, well, we've got a wonderful panel for you today. And I'll introduce the panelists. Come on up. No need to do it in order. But we've got Chris Grizzard, who's a VP with Bayshore Capital. We've got Venkat Ramaswamy, who's with Edelweiss Alternatives. And Mike Tierney, who is a managing partner and co-founder of Tanarra Credit Partners. Welcome all.
Thank you.
Let's go down one.
And with that intro, I'll just take a seat if that works.
Yeah, let's take a seat.
Much more intimate. So before we kick off, why don't you guys spend a little bit of time just introducing yourselves, your firms, what it is you do, with an eye to sort of outline the contours and the full range of the opportunity set in Asia.
So with Tanarra Credit Partners, I left a 25-year banking career to set up a credit fund 2 years ago called Tanarra Credit Partners, with my partner, Peter Zeckley, who's in the audience here today. And, the key is focusing on the opportunity set where private credit is becoming a very, I think an undervalued opportunity set in the investment market. We are seeing a tremendous growth in private credit, particularly in the Australian and Asian markets, driven on the back of the impact of regulatory changes, the impact of Basel III, and the withdrawal of banks from the lending market. So we are seeing above-market returns in the credit space, and we think it's a huge allocation opportunity for LPs going forward.
Venkat.
Hi. Edelweiss is a 22-year-old firm. Edelweiss Alternatives is about 9 years old. We focus only on private credit as a business. Our clients are predominantly insurance companies and pension funds from all over the world. We have total assets of $9.5 billion. We are significant on the NPL side and have a meaningful business on the performing credit side. We are private credit only.
Okay, so NPL, India. Chris?
Yeah, hi, Chris Grizzard with Bayshore Capital. We're a Florida and London-based private client advisory and multifamily office. I lead our diligence and research in private investments, so PE, VC, and private credit. We have been, I'd say, fairly significant allocators to private credit for a number of years. I think since 2009, we've allocated to 20 or so strategies globally, and we've seeded a number of funds, and we also manage 2 private credit fund-to-fund portfolios in-house.
Okay, so a very broad array there. I think that's an important takeaway. Whenever I talk about private credit or I appear on these panels, that's one of the things that I always want to do, is just to identify the fact that it's a very big tent, and there's a lot of different strategies in there. And so with that, having established that, let's talk about the opportunity set and the strategies that are really being driven by that. So is it safe to say, Venkat and Mike, that the banking sector and the changes that are going on there across the jurisdictions, and perhaps you could give us some views as to any specific jurisdictions where perhaps this type of change might be most acute. Tell us a little bit about that driving, the opportunity set being driven by that.
So in terms of looking at that opportunity set, if you look at the overall, it's the most important thing is to look at the overall market size. The actual Asian private credit market is in the order of $35 to $40 trillion. And that includes bank and bond. But, when you drill down into the subsets, there is Australia alone is 2.8 trillion of that particular number. The vast majority of the 40 trillion is actually China. So we're not going to focus on that, I don't think, today, but we're looking at where are the relative values. Out of the Australian $2.8 trillion market, it's very interesting that in terms of private credit in the sub-investment grade area where you are generating above market returns, you're generating alpha, where the banks themselves are exiting that particular market. The size of that market is $12 billion. It's around about $12 to $13 billion. And in the last 12 months, out of that market of $13 billion, 30% of that has been, of that funding has been directed to new LBOs. Another 30% has been directed to refis, and another 30% has been directed to dividend recaps. What is very clear is the opportunity set that creates in terms of the fact that most of that funding opportunity is not being serviced by the banks, who are the traditional lenders. They are exiting that market, and the reason for that is this: it's in the double B, single B credit space, and on top of that, the banks are being constrained by the impact of Basel III and capital charges, and there is a withdrawal of capital from that space. So there's a tremendous opportunity for new funds, new credit funds, new institutional credit funds, and LPs to invest in that area.
That's Venkat, do you see the same type of, with the RBI in India, do you see the same type of dynamic unfolding?
Yes. So, so the India market, India is basically a bank market, and the total credit outstanding is around 1.3 trillion. And I will speak about two parts of the markets that we are interested in. So one is the NPL market, and India currently has about 12 to 13% NPL. So the size of that market is around $165, $170 billion, and which currently is presenting a large opportunity for investments to foreign as well as Indian NPL players. And this, mind you, India is not a bond market, it is primarily a loan market. And so returns, and we now have a bankruptcy code, and maybe I will speak a little bit about that further down the line. And the other part of the market is the private sector credit market, and currently the size of that market is around $2 trillion. And out of that, the private sector banks is almost $1.4, $1.5 trillion. So the direct lending funds, private credit funds market is around $400 million, and $500 billion. It has been predominantly played at with permanent capital vehicles called non-bank finance companies in India, but we are starting to see private credit, direct lending funds come about in India currently.
And so Chris, as you think about allocating to Asian managers, to what extent do you look at, and to what extent do you take into account the ability to specialize in a particular geography, the rule of law and the underwriting approach? Because there's clearly an opportunity set, right? You got the banks exiting across the region. How do you look at those things when you think about allocating capital?
Yeah, I mean, so obviously APAC's a big region, lots of different geographies within there, and they're quite different from each other. I would say what we actually see is a lot of groups that are sort of Pan-Asian that play across different markets. We have focused more of our time on sort of more developed parts of Asia, so Australia, New Zealand, Singapore, Hong Kong, maybe some in Korea, and frankly less in India or directly onshore in China. But I think you do see teams that try to play across jurisdictions, but they do it in a way that has sort of a local presence where, for example, one of our managers, I would say their largest allocations are probably Australia, Hong Kong, and Singapore in that order, and they have offices and investment and operational personnel in each of those jurisdictions. I think that's it's very important. And then I think as you think about where you want to try to transact, I mean, take somewhere like Singapore. Depending on the type of transaction, that's a great place to tie up collateral if you can. We've done quite a bit of securities backed lending, and so if you have a publicly listed security, Singapore is a great place to have that asset sort of tied up. They have great recoveries on par with sort of the US and the UK. When you have defaults, and then the time to recovery is even faster than the US and the UK. So we think about things like that when we think about where we want to have managers be active.
Yeah, it's interesting. When I first came out here last year, the year before, and I went and I talked to a bunch of different managers, all over the region, and really they all agreed on two things. One, you can do business in Australia, and the other thing is that everybody else is crazy. So you talk to one manager who does business in Indonesia, never touch India. Go to someone else, oh, we only do business in India, we would never lend money in Indonesia. So it was quite eye-opening. But and to that point, Venkat, let's talk a little bit about the bankruptcy code in India and and what's going on there.
So it is a significant law that has got passed about 18 months ago. So it is, in my view, still in the test period where the law is being tested by companies which have been dragged into the bankruptcy process or the existing owners of the companies which are in default, because in India, our current bankruptcy laws do not allow the existing management to bid for their own company, and which has led to, in my opinion, figuring out true value of these businesses. And the banks are currently surprised at the value that the bankruptcy process has been able to unlock. One of the largest, case in point is one of the largest steel companies in India got dragged into bankruptcy, and the existing owners, just before it got dragged into bankruptcy process, offered 55 cents to $1. And last week, ArcelorMittal offered 100 cents to $1. So, and that is what has happened in 9 months of this process. However, we are running behind schedule. So originally it was, everything was supposed to get over within 9 months of a company getting dragged into this process. It is taking longer, but it is definitely making the system stronger. And I think this will help India attract a lot more capital into the credit markets. And I'm excited about what it's doing.
So, in light of that, in light of the kind of the growing opportunity set, we've got Australia with the Basel and bank regulation. We've got the same dynamic in India with the bankruptcy code introduction as well. Let's pivot a little bit. So, what I heard both of you say, and Chris, correct me or back me up if you think I've got this right or wrong. The need for long duration assets, or rather the opportunity set is really in the long duration, not necessarily the trading aspect of it, right? It seems like there's longer, even on the NPL side. Let's talk a little bit about fund structures, how your funds are structured in terms, investment period, exit, use of leverage, no leverage, and as we work our way down, I'd like to hear from Chris preferences that you're seeing from your clients and how you allocate with respect to different fund structures. But let's kick off with Mike over here and a little bit about that. Like, do you have a leveraged sleeve? Does Tanarra have a leveraged sleeve, an unleveraged sleeve? How do you assemble your liabilities?
Well, in terms of our liabilities, I mean, our focus is clearly on looking at the opportunity set that does arise. If you look at, we're an unlevered fund, so we aren't unlevered. We're looking at a straight return to investors unlevered of 8% on a senior secured basis.
Now, is that because you can't get leverage?
No, we can get leverage, but it doesn't drive the. I mean, if we were to try and raise a future fund, like a second fund or a third fund, I mean, we would add leverage, particularly because it's a requirement. But it probably drives returns by another 1.5%, and it does mean a lot. In terms of performance, though, if you're looking at performance, what's driving performance? There's a couple of key issues that we really think the Asian market, across the board is very attractive. It's attractive because if you look at the leverage multiples in Asia versus the US, the average leverage multiples, and these are stats that anybody can look at, is around about 6.5 times leverage in terms of LBOs. In Asia, it's close to 4 to 4.5, maybe up to 5 times. So you've got this leverage discount. That's one. 2, pricing is sustainably higher. So there is a pricing arbitrage where pricing is at least 150 to 200 points at the moment above where US credits are on a comparable basis. Now, the reason for that is because there is an illiquidity premium that you have to take into account for an Asian credit, because it's not as if you're buying a term loan B or some liquid piece of paper and you can trade it. But we believe that Tanarra Credit Partners believes that illiquidity premium is probably between 75 and 125 points, but it's still you're getting paid a premium above that illiquidity premium. So it's a market that is actually undersupplied. There is definitely a supply-demand imbalance in Asia for private leverage credit, and that actually takes into account an illiquidity premium where I think investors are seeing above market returns. The issue then becomes do you have the appetite for holding to maturity on those assets?
So you mentioned you compared the leverage multiples in US and Europe to what you're seeing in Asia. So I have to ask, are you seeing the same type of deterioration in documentation and the rise in EBITDA add-backs that we're seeing in the US?
Yeah, it's a very good question. It depends on the jurisdiction. Okay, so I think in a lot of presentations we've heard over the last 2 days, there is clearly, you've really got to pick your market. If you're in Australia, for example, we have probably the best, it's a bit like Europe and the US, we probably have some of the strongest documentation requirements. Not only are you getting, lack of add-backs and everything else, you're actually getting full covenant, you're getting full covenants, you're getting full security. There's no such thing as covenant light, So you're actually getting a better credit, in terms of from a security structure and a capital preservation structure than you would see anywhere else in the world right now. Plus, you're getting a premium. However, if you go to other parts of Asia, I'd be interested in my colleagues' views on that. Australia is a very credit-friendly market because of the common law rights that creditors have. But in other parts of Asia, how do you preserve capital in a loan directly into China, for example?
Okay, well let's ask our colleagues with Chinese exposure. But and Venkat, I'm gonna go to you first for India, and if you could mention a little bit about kind of and we just talked about the bankruptcy law, but if you could wrap that into discussion about kind of the fund structures that you have as well.
So all our fund structures are private equity drawdown structures.
So what's your investment period roughly?
6-7 years. No, 6-7 year fund size.
Fund life.
So investment periods are typically 3 years, max 4. And we do not have leverage in any of our funds. We are able to deliver net returns of 14-15% in rupees.
Okay.
And in the sense that there has been a lot of noise around how, because of lira, and I don't know why, the emerging market currencies are yo-yoing a little bit. But I just wanted to make a point. If you look at Indian rupee against every currency other than the US dollar over a 5-year period, it has been flat or appreciated against that currency. And we have clients in Australia, we have clients in Canada, and all of Europe. And against the US dollar, even though the currency has depreciated this year by 11%, most people do not remember that it appreciated by 6% last year. So average has been 3% depreciation. And if we are able to deliver unlevered returns of 14-15%, it comes to around 10-11% dollar.
So India is growing in attractiveness, obviously, in the private credit space. As more capital flows in, any plans to potentially offer some sort of a levered vehicle Is that something you could do against the US dollar, or is that too expensive?
So no, it's possible to do. It is available, and like he mentioned, it improves returns by 1% or 150 basis points. So which is, so far our clients have not asked for it, but maybe if the returns start going down, if there is too much money comes in, returns will start going down, and maybe then there is a need for leverage. But currently, we don't have, and none of our clients have asked for leverage.
So Chris, when you allocate, where do you like to allocate? Do you have a preference with respect to lockup vehicles, hedge fund vehicles, liquidity? What do you think of Michael's 75 basis point to 125 basis point liquidity premium? How do you view the allocation from that perspective?
I mean, so we have an appetite, I would say, that's sort of across the liquidity spectrum, but we don't want to be mismatched. A lot of, I think, the funds, the private credit funds, at least the ones that have been around for a while in the region, probably like a lot of funds, in developed markets, pre-crisis might have been set up as hedge funds when they were, lending money out, in totally private markets for 3 to 5 years, and obviously that was not a good idea and didn't end necessarily very well. So I think you have some of that legacy here still, where you have funds and managers that will maybe structure something that looks a little bit more like a hedge fund that has largely private assets, but the lockups are long on the way in, and so I think that's mitigated to some extent. Trade finance is something that we like a lot because the underlying loans can be maybe 180 days, even 90 days. We do that out of Europe. We have not seen as many strategies sort of dedicated to Asia in trade finance. I think maybe just 1 or 2. So I'd love to see more of that. So that's probably where you can get the most liquid. But typically, our preference is drawdown private equity style vehicles, and I think that's what more and more people are migrating towards. Certainly, U.S. investors have been comfortable with that for quite a while, and I think European investors are following suit, getting more comfortable with the illiquidity, and certainly where there are institutions that are active, they almost exclusively require that. So that's probably what we see on the fund structure side.
And what role does currency play in your capital allocation decision? Are you more focused towards the more easily hedged currencies? How do you take that?
Yeah. So in private credit, we're pretty focused on trying to do something either that's very cheap to hedge, or just funding in U.S. dollars. Obviously, Hong Kong dollar is not an issue if that's at all preferred by the borrower. But so Australia, fairly easy to do that in local currency, and that pair is fairly cheap to hedge. We would not want to lend probably in any of the local currencies. Rupee, we probably wouldn't do that just because in private equity, we're fine taking that venture, we're fine taking that FX risk because as a percentage of the total return, it represents less. But in private debt, where maybe your best case bogey is sort of, we think in the region is sort of maybe low to mid teens. If you have a -7 or 8% year in currency devaluation, that's really going to show up. So we prefer to focus, and I think this ties back to the countries that we focus in the region: Australia, Hong Kong, Singapore, places where the currency is not an issue if they want to borrow in local currency. But we would prefer, honestly, just to have it funded in dollars. But then you need to worry about how does that line up with the borrower's business. And so you either need to have them, if their revenues are in foreign currency, then they need to have a hedging strategy in place and make sure that they can sort of execute on that.
And let me just ask you one final question. You mentioned that you're underwriting to about mid-teens returns.
Yeah, low to mid-teens.
Now, how, do you view that from an absolute basis, or do you view it as relative to your opportunity set in Europe and the U.S.?
I think clearly there's a risk premium from being, in Asia Pacific versus being in the U.S. or Europe, and we think it's, I would say it's maybe a little bit higher on a fund level basis, maybe a few hundred basis points is what we typically see and what we would typically expect, and I think what our clients would expect. But we view Asia and everything on a sort of a portfolio basis, and so while we can take some risk, maybe 10 to 20% of our portfolio in private credit in the region, the returns, maybe you have a low to mid-teen IRR target, but overall we think we're actually probably reducing our risk by having something that's outside of the U.S., outside of Europe. Typically they don't move in lockstep from sort of a macroeconomic standpoint. So we think while adding to our returns is great, but we're also probably reducing or at least not increasing our overall private credit portfolio risk.
So that's a great point, because we've got some of our clients have come to us and asked us to start looking at private credit managers in Asia for specifically what you just mentioned, which the opportunity set is more for diversification. It's not a yield hunt. It can be to a certain extent, but I'll ask Michael and Venkat, to what extent does your LP base view the opportunity set and allocations to your funds as precisely that?
Yeah.
I've got too much in the U.S. and direct lend or something.
Yeah, it's great, very great question. We set out and set up we've set up our first fund. We've raised $300 million. We're about to close on $500 million by the end of the year for our first fund, and we've allocated 40%. The majority of our investors are Australian LPs. They're very conservative. They're not looking for 15% returns or 12% returns. They're looking for 8 to 10, and they're very excited about that. And the reason for that is that that's 600 over base on a senior secured loan. They're getting diversity. They're looking at their currency exposure. The lack of need for hedging. So they're looking at Australian, New Zealand risk or US dollars, because we also can invest in US dollars, and we like the liquidity in US dollars. But it comes down to where the LP's credit appetite is and where it sits in their bucket, right? Does it sit in their cash bucket? Does it sit in their alternatives bucket? Does it sit in, where does it actually sit within their credit portfolio allocation? And we've discovered that there is a huge amount of inflows coming into this the credit space. If you just look at just the Australian market, the size of pension funds, superannuation money coming in every year, it is enormous, and it's underweight credit. So there's this wave of credit allocation that's going to have to continue, but it's got to be sustainable. And what we've set up is, our fund is not just Australia, it's Asia Pacific. So we actually have an office in Hong Kong, and we're looking for actually opportunities up here in US dollar terms that we can hedge back into the base currency of the fund, etc. But the point is this: returns, I think, are relative to where it sits in the fund's allocation, and we are not a distressed or alternatives fund. We are a performing credit fund, and we're targeting that kind of 10% return, like stretch target, as opposed to trying to hit the 15% returns. And I think it's a very key point. Right?
So Venkat, where does Edelweiss sit amongst? And I know you've got a lot of LPs. It might be too hard to generalize, but so do LPs view Edelweiss in India as a diversifying opportunity, as a great yield opportunity? What exactly are they looking at? How are they looking at you?
So our clients are not able to find enough yield because of their size in a lot of developed markets. And we do only senior loans. So we are not sitting somewhere in the stack. We are not mezz. So all our products have collateral behind them. And so, which are senior loans and NPL or performing. So they are getting diversification. They are getting an ability to invest meaningful amount of capital. Like, we got our first Australian client, Australian superannuation, and for them it is diversification. In the sense, they are concentrated in Australia and a little bit in Europe. They don't do US, and it does provide diversification. And like you said, the Asian markets for now don't seem to move in tandem with the developed markets.
Yeah, no, it obviously, if you look at, you know, private credit yields, particularly direct lending market in the developed markets in the U.S. and Europe, I think that there's some daylight between what some of the levels you both mentioned. So I know that I want to be cognizant of the time. We have about 10 minutes left, and we want to leave about 5 minutes for questions. So I always like to have a little wrap up, and we talked a little bit about this. If you were to leave the audience with a couple thoughts as to what the opportunity set is now, we already talked about. Where's it going to go? How's it developing? Where do you see it? Do you see it continuing to grow as an allocation? Do you continue to see what you're seeing now?
Absolutely. I think the banks are contracting. I don't think you've seen the impact of Basel III on the Asian banks yet. It's really hit home in Australia and New Zealand and in Europe. You're seeing banks just withdrawing from the market in terms of sub-investment grade lending, you know, where you can get alpha, where you can get yield. And you're going to see that develop across Asia Pac. So that's a thesis, and that is definitely going to continue. Not only that, you're seeing this weight of money coming through on the pension fund side and they're underweight credit. So that's the first point. The second point is there is just no competition in, there's no real competition for us in the, institutional credit lending space. You know, we find there's 3 or 4 competitors that we compete against in the region, and we don't compete against them on deals. They just don't show up. So where we're at the moment is that you're just creating a huge amount of alpha for clients. I think that's going to continue for a number of years because I think it's going to take a long time for that structural adjustment to work its way through.
Venkat, what do you think?
So India is currently growing at around 7.5%. It is the fastest growing large economy in the world. We are in our journey to go from 2.5 trillion to 5 trillion by 2025, 2026, depending on whether you're reading Credit Suisse report or Goldman Sachs report, right? So in that journey, if you look at private credit, currently the size of the market is $2 trillion. Our private credit debt to GDP is only at 80%. China is at 210%. US is at 150%. So if people believe that we will go from being a $2.5 trillion economy to a $5 trillion economy in the next 7 years, the opportunity for in all forms of private credit, depending on what is your comfort level with risk, the opportunity is extremely large. There aren't enough players who are playing this market. With our bankruptcy laws in place, investing in credit makes a lot of sense in a risk-adjusted manner compared to, in my opinion, any other asset class that one can play in.
So, Chris, hearing Venkat and Mike, when you get back to Tampa, you're going to double the allocation to EM private credit?
Yes.
Maybe Asian private credit, not EM in general, but South America has given us some problems. I think, look, again, everything for us is a portfolio decision, but you have a market that's clearly growing faster than the US and Europe. And you still just have very low penetration for, private debt, private investment capital into private debt funds. And so, in the US where we talk to our managers and they say, well, it's getting pretty competitive. This deal got repriced on us. This one we got refied in, inside of 6 months. We thought it was going to be a nice piece of paper for 2 or 3 years. We don't see that here. The private debt managers that we speak with don't compete against each other very often, like Michael said. And so I think you have, a lot of things in your favor, and it should be that way for a number of years where you really have some really nice risk-adjusted returns in the region as part of a portfolio as an LP. I think it's very attractive. And the last thing I think is that, as you think about the region, we found the teams that we've gone through, and I mean, if we're looking at a strategy, we're trying to talk to all of their peers and really try to find a best-in-class manager. But the teams are often very deep and have really good experience and have been in, you know, a lot of times it's been at the banks or maybe on a prop desk or something where they used to be more active here in the region, and you know, they decided to stay and you sort of hang up their own shingle. But the track records of either the shops as they are currently set up, or at least the, you know, the senior individuals is really quite long and for the most part really impressive. And so, you know, I feel like maybe even relative to you know, the U.S., where maybe it's a little bit easier to raise a private debt fund there, you have very capable teams, very deep teams, you know, teams with, you know, people from all kinds of different backgrounds, whether it's, you know, by country or by sort of, you know, professional background, you know, internal legal teams and things like that that are really impressive. So,
Okay. Thanks, guys. So on that note, I think we have about 3 or 4 minutes left. So why don't we dedicate with what little time is remaining to any questions that the audience might have? Yes, sir.
Brian Bunker from Riverside. Quick question on fundraising. I believe a couple of years ago there were about 80 debt funds in the market in North America. Question for Mike. In Asia and particularly in Australia, how are you finding the appetite for new debt funds?
Yeah, it's very strong. I think there's a reweighting of allocation amongst the superannuation funds who are really driving it. We received a $200 million allocation in our first fund from one particular fund, which was great, and then something similar as well. But you know, there's a consolidation going on. One of the distortions in the Australian market is the impact of this regulation called RG97, which relates to super funds having to report the fees that they're being charged by fund managers, and what that's driving is a behaviour where they're more fee focused rather than return focused. So you know, there's a kind of a strange distortion in the market. So Australia's probably driving the global fee market down in terms of, you know, credit and equity right now. And it's very hard for foreign you know, fund managers to raise money in Australia right now because of the fee compression issues. Having said all that, the amount of money that's flowing into the Australian economy is huge. So if you can get scale, if you can find scale in the Australian market, it's really quite impressive because the inflows are huge. People may not be aware that. But in the pension fund market at the moment, 10% of every employee in Australia, 10% of their wage goes directly into a pension fund automatically. So there's this massive build-up of pension funds that are looking for investment opportunities. A lot of that money is going offshore, but more and more they're allocating to domestic managers as well. And so you only need a small proportion of that to be really, you know, to really build scale. So, you know, hopefully that answers your question.
One more question.
Taz says one more. Yes, ma'am.
Are your returns levered or not?
No.
No, unlevered. Unlevered.
Both unlevered, yeah, unlevered.
Okay.
We've analysed it. You know, the impact is the same. It's about 1 to 1.5%. You know, improved returns if we were to lever it. And our investors aren't looking for leverage. You know, they're not interested right now.
All right. Well, thank you, guys. Got to make time for the next panel, but thank you, gentlemen. It's very enlightening.
Thank you.
Thank you very much.